Everyone is completely wrong about how high XRP can actually go. And I don't mean a little wrong, I mean fundamentally, mathematically wrong. Today, I want to show you something that almost nobody in crypto talks about properly, but it changes how you should think about XRP's future forever. This isn't hopium, this isn't vibes, and this isn't some random Twitter prediction. This is about how price actually moves, how capital actually impacts market cap, and why the common argument of XRP can't hit null is because of market cap is one of the laziest takes in this entire space. Welcome back to Journey to XRP. If you've been here for a while, you already know I don't waste your time with fluff. We break things down logically step by step, regardless of whether the conclusion is bullish or uncomfortable. And today's breakdown is one that, in my opinion, is going to flip how a lot of people look at XRP's long-term potential. Because everywhere you look online, you see the same comments. XRP can't go to $100 because the market cap would be too big. XRP can't go to $200 because it would be bigger than Apple. XRP can't go to $300 because that would mean trillions of dollars. And on the surface, that sounds smart. It sounds logical. It sounds like someone who understands fundamentals. But in reality, most of those people don't understand the most important part of this entire equation. Market cap does not equal the amount of money that actually flows into an asset. Let me say that again, because this is the core misunderstanding that holds people back. Market cap is a reflection of price multiplied by supply. It is not a running total of how much cash entered the market. If XRP doubled tomorrow, it would not mean that the entire market cap of XRP in dollars suddenly flowed into the asset. The real inflows that move price are a fraction of that number. And recently, we got hard data that finally puts real numbers on this concept. This came from analysis being discussed publicly by Chad Steingraber and Zach Rector. What Chad tracked was a real-world inflow event on XRP. In a 30-minute window, about $478 million in net inflows hit XRP, and during that same window, XRP moved from about 215 to 220. On the surface, that doesn't sound dramatic. 5 cents doesn't feel life-changing. But when you apply the math behind what that move actually represented in terms of market cap change, that's when things start to get very uncomfortable for the XRP can't go high crowd. Zach ran the numbers on what that inflow meant relative to market cap expansion, and what he arrived at was a market cap multiplier of roughly 598x for that specific price movement. In simple terms, what that means is that for every single dollar that actually flowed into XRP during that window, the market cap expanded by nearly $600. That's not speculation, that's math derived from a real observable price move. Now, before anyone loses their mind in the comments, no, this multiplier is not fixed. It changes depending on liquidity, market conditions, volatility, order books, and overall sentiment. But the point is this, even at a fraction of that multiplier, XRP is far more sensitive to capital than most people realize. Think about how insane that actually is for a moment. If a relatively small inflow of a few $1 million can move market cap by hundreds of millions, what do you think happens when you're no longer talking about retail traders with 5-figure positions, and you start talking about institutions that deploy capital in 9-figure and 10-figure blocks? This is why it would take trillions of dollars for XRP to reach Chachachurimi argument completely falls apart. Prices do not rise because trillions of dollars march in one by one like soldiers. Prices rise because liquidity gets overwhelmed, supply gets absorbed, and the marginal buyer is forced to pay higher and higher prices for the same unit of XRP. That's how price discovery actually works. And this is exactly why most people miss the move every single cycle. They anchor themselves to static numbers. They anchor themselves to outdated logic. They anchor themselves to what feels impossible instead of what the math quietly allows. Right now, XRP is sitting in that exact danger zone where the crowd feels comfortable dismissing higher prices, not because the data rejects them, but because psychologically they seem unrealistic. And historically, that is always the phase right before assets stop moving rationally and start moving aggressively. This is why I've said many times on this channel, the people who win in crypto are not the ones who predict exact prices. They're the ones who understand structure, liquidity, and capital flow. And once you truly understand how little money it actually takes to expand market cap in the right environment, your entire ceiling for what's possible with XRP changes permanently. This is the foundation. This is the base layer. And if this single idea doesn't click for you, nothing else about XRP's long-term potential will make sense either. Now let's push this one level deeper, because this is where most people still mess it up even after they understand the idea of multipliers. Even if that 598 multiplier drops by 50%, even if it drops by 70%, even if it drops by 90% over time as liquidity improves, it still leaves XRP with an explosive sensitivity to capital. And that's the part the market cap argument completely fails to process. Let's get conservative for a moment. Let's say the real world multiplier over the next few years averages out to just 100x instead of nearly 600x. That means every 1 billion that flows into XRP expands the market cap by roughly $100 billion. At current prices, that kind of move would already create massive price shifts. And $1 billion is pocket change for institutional capital. That's not a bold assumption. That's not fantasy. That's one routine allocation from a single large fund. Now, here's where the real game changer comes in: Ripple's escrow. For years, institutions have had a backdoor to obtain XRP without impacting price through OTC deals directly from Ripple's escrow. That means massive allocations could be absorbed without hitting the open market, which is exactly why we haven't seen the kind of vertical supply shocks that would normally accompany large capital deployment. But that situation is temporary. Ripple's escrow is not infinite. It continues to decline. And as that remaining escrow dries up, institutions that want exposure will have only one option left: the open market. And the moment that happens, price behavior shifts permanently. Supply tightens, slippage increases, and the same amount of capital suddenly moves price far more aggressively than before. This is not theory. This is how every illiquid to liquid transition works in markets. The early phase feels controlled, the late phase feels violent, and now stack that reality on top of what's coming next: institutional accessibility. Because once XRP becomes easy to buy at scale through regulated products, whether that's ETFs, structured notes, custody platforms, or retirement accounts, the friction that kept capital sidelined collapses. And once friction disappears, allocation becomes automatic. You stop needing conviction. You don't need believers. You just need portfolio models. This is what Bitcoin already went through. This is what Ethereum already went through. XRP is simply late to that party because of legal drag, not because of infrastructure weakness. Now pause right here and understand how absurd this setup actually is from a market structure perspective. High sensitivity to capital, shrinking off-market supply, expanding institutional access, and global payment utility already in production. That's not how markets die. That's how they detonate. And yet most people are still debating whether XRP can even deserve higher prices. Markets do not award fairness. They respond to liquidity, necessity, and access. If capital needs XRP to move, price will move whether retail feels emotionally comfortable with it or not. Now add one more layer that almost nobody talks about properly: price anchoring. Most people judge future price based entirely on where the asset came from. If XRP traded at year 20, then $2 feels expensive. If XRP traded at $2, then $20 feels expensive. If XRP traded at $20, then $200 feels insane. But markets do not move in smooth psychological ladders. They move in regime shifts. Once utility-driven demand overtakes speculation-driven demand, price behavior changes completely. Volatility compresses, corrections shorten, and valuation models stop looking like crypto and start looking like infrastructure. People don't argue about the market cap potential of Visa every day. They don't scream that Swift is overvalued, because when something becomes a rail instead of a trade, price psychology evolves. Now let's destroy another weak argument while we're here. There are too many XRP coins. Supply without context is meaningless. Distribution, velocity, lockups, usage, custody, and collateralization matter far more than raw token count. If XRP is increasingly locked into settlement rails, treasury systems, liquidity pools, reserves, ETFs, and custody providers, then the effective float shrinks regardless of the headline supply number, and price does not move against total supply. It moves against available liquidity. That's the part most people still don't understand, which brings us to the uncomfortable truth. The price levels people currently call impossible are often the ones that exist specifically because supply is already positioned off-market before demand arrives. And once the door opens, the move happens faster than most people emotionally prepare for. Right now, XRP is sitting in a phase that historically precedes violent repricing. Utility adoption is accelerating, institutional access is expanding, supply control is shifting, and capital sensitivity is extreme. This is exactly the phase where people get shaken out emotionally because price feels boring right before it stops being boring. The crowd always underestimates the move right before the move arrives. And if you don't understand the mechanics behind that, you will misjudge XRP every step of the way. Now let's connect this to the real catalyst most people keep underestimating: institutional entry timing. Everyone loves to talk about institutions like they're already here in force. They're not. What we've seen so far is positioning, sandbox testing, and regulatory preparation. The real capital doesn't move first. It waits until rules are unambiguous, access is frictionless, and custody is bulletproof. And that's exactly what's being built right now around XRP. Think about it logically. Big funds do not gamble on assets with unresolved legal status. They don't rely on probable outcomes. They wait for certainty. That is why XRP has felt suppressed for so long while weaker projects ran wild. XRP wasn't weak. It was legally frozen. Now fast forward to where we are right now. Escrow supply shrinking, ETF probability climbing, institutional execs moving into Ripple, banking rails already active, and regulators no longer hostile. This is not coincidence. This is sequencing. Markets move in waves of permission. Retail speculates without permission. Institutions wait for it. And once they're allowed in, they do not tiptoe, they allocate. Now combine that with the multiplier concept from earlier, and you start to see the danger most people are missing. You don't need every bank in the world to buy XRP. You don't need every hedge fund to allocate. You only need a small number of very large players to move medium capital at the same time. That's it. 5 institutions allocating $2.5 billion each into XRP over a short period would create structural stress on supply, not theoretical stress, real order book stress. That's when bids gap. That's when price teleports. That's when retail realizes price moved so fast that the dip never printed. And that's exactly how most life-changing crypto moves actually happen. They don't walk upward, they gap. Now let's impose some discipline here, because this is where hype usually takes over logic, and I'm not letting that happen. Does this guarantee XRP hits extreme numbers? No. Can macro conditions delay it? Yes. Can risk events disrupt it? Absolutely. But the direction of pressure is no longer debatable. Pressure is building on supply, access, regulation, utility, and capital flow structure. That is not how tops form. That's how bases form before trend expansion. Now here's another uncomfortable truth most people avoid. Retail psychology is structurally weak at this stage of the cycle. People are exhausted. They waited years. They watched other assets outperform. They watched narratives rotate. And now many holders are mentally in a sell the next pump mindset. Institutions love that. They don't want euphoric holders. They want motivated sellers. They want liquidity without resistance. And exhaustion creates liquidity. That's why markets tend to move hardest right after sentiment breaks. Now tie this back into the escrow reality one more time. For years, Ripple's OTC sales acted like a shock absorber. Big buyers could accumulate without price responding violently. That era is ending. And once it ends, accumulation becomes visible. Visible accumulation changes behavior. It changes derivatives. It changes funding rates. It changes order flow. It changes sentiment in days. Now add one more layer people don't like to confront. Global adoption is not synchronized. The US moves slow. Asia does not. The Middle East does not. Latin America does not. Institutions outside the US are not legally paralyzed like American funds were. So while many US traders still argue about if, large foreign capital is already experimenting with how. That is how trends start quietly. That is how repricing begins before headlines. That is how retail always ends up reacting instead of positioning. Now we get to the cold reality most people ignore when they daydream about massive prices. If XRP truly transitions into a high-velocity global settlement layer, price appreciation will not be linear. It will shift into regime behavior. High liquidity, lower percentage volatility, larger absolute price moves, and long-duration trend expansion instead of boom-bust cycles. That's when price stops behaving like a speculative toy and starts behaving like an infrastructure asset. And infrastructure assets do not need hype to climb. They climb because money must pass through them. Right now, XRP is still emotionally traded. Later, it becomes operationally required. Those two phases do not produce the same price action. And the biggest mistake you can make is assuming the future will feel like the past. It never does. Right now, XRP is boring to most people. That's not bearish, that's preparatory. The final ingredient before major repricing is apathy. And we're dangerously close to that phase now, which means the next move probably won't feel fair. It won't feel gradual, and it sure won't wait for consensus. Now let's address the question most people keep dodging because it makes them uncomfortable. What happens when large capital is forced to buy on the open market instead of through closed doors? This is the moment everything changes. For years, Ripple's OTC pipeline acted like a backstage pass for institutions. They could accumulate quietly, negotiate pricing, stagger settlement, and avoid alerting speculators. That kept XRP's public price artificially calm, even while serious positioning was happening behind the scenes. Once that door closes, every large buyer becomes a visible buyer. That's when price no longer moves politely. Now layer in the supply reality that almost nobody truly internalizes. Total XRP supply is fixed, but liquid supply is not fixed. It fluctuates based on long-term holders, exchange reserves, institutional cold storage, escrow releases, and regulatory constraints. When institutional demand meets shrinking liquid supply, something mechanical happens. Slippage increases. And when slippage increases, price acceleration follows even with the same capital input. This is why price models based purely on linear inflows are misleading. Markets don't move linearly under constraint. They move elastically. One large order in a thin book doesn't add to price, but it reprices the entire curve. Now combine that with the multiplier effect you discussed earlier. Even if that exact 598x relationship fluctuates over time, the core principle remains untouched. Market cap expansion always outpaces raw inflows when liquidity is constrained. This is how assets jump tiers. They don't climb from $2 to $10 because 10 billion flowed in. They climb because 2 billion flowed into a thin market that could not absorb it smoothly. That's why people always underestimate the first real institutional wave. They apply retail logic to institutional behavior, and that's a fatal mistake. Retail enters emotionally, institutions enter structurally. Now let's confront the emotional landmine in your audience's head. Yeah, but if XRP goes up big, everyone will sell. No, not everyone. Only weak conviction sells early. What actually happens is distribution across psychological stress levels. Some sell at 2 times, more sell at 5 times, many freeze at 10 times. Almost nobody times the top. But here's what most people don't realize. Distribution does not cancel trend when demand is structural. Speculators sell into momentum. Institutions buy into infrastructure. Those are not equal forces. Speculators provide volatility. Institutions provide trend. That's why speculative tops die when institutions exit, not when retail sells. And right now, institutions haven't even entered at scale yet, which means we are not debating a top. We are debating an ignition point. Now zoom out further. Global capital doesn't rotate instantly. It flows in phases. First into futures, then into ETFs, then into custody platforms, then into balance sheet allocations, then into treasury strategies. Every phase multiplies access. Every access layer multiplies demand. Every demand layer increases baseline price. That's how assets stop being traded and start being held by default. Once XRP crosses that line, the question stops being, will it go up? The question becomes, what is its structural role in the system? And structural roles don't get priced at $2. They get priced based on volume processed, velocity of settlement, regulatory trust, and replacement cost of legacy systems. At that point, price no longer obeys retail expectations. It obeys financial gravity. Now, here's another hard truth your audience needs to hear, whether they like it or not. If XRP truly becomes core financial plumbing, most people will not be allowed to accumulate large positions at low prices. Liquidity will dry up. Regulated vehicles will gate access. Institutions will front-run issuance, and retail will be offered exposure, not ownership. That is how every major financial asset matures. Gold did it, oil did it, bonds did it, even equities did it. Crypto will not be the exception. So when people casually say, I'll just buy more later, what they're really doing is assuming the market will always give them a second invitation. It doesn't. At some point, an asset becomes too important to remain cheap. And once that transition begins, it cannot be undone. Right now, XRP is sitting at the exact psychological intersection where believers are tired, skeptics are loud, institutions are quiet, and the infrastructure is almost finished. That is historically one of the most dangerous places for a price to sit. Dangerous for those who wait too long. Because the breakout that matters the most is the one that feels undeserved. Now let's land this plane properly, because this is where most people either mature as investors or stay trapped as reactionary traders forever. Everything you just walked through, the inflow mechanics, the multiplier effect, the slow death of OTC supply, the compression of liquid supply, the arrival of regulated products, none of that guarantees you instant riches. What it guarantees is volatility with direction, and that's where most people break. Because everyone loves the idea of generational upside until the screen flashes red for 3 weeks straight. Everyone talks diamond hands until the first real pullback after a big move wipes out their short-term profit and tests their emotional tolerance. This is why most people don't lose money because their thesis is wrong. They lose money because their nervous system can't handle being right slowly. Here's the uncomfortable truth. If XRP does what the structural math suggests it can do over the coming years, most people watching this video today will not hold through it. They will sell after the first major win. Then they will re-enter higher. Then they will panic sell again. Then they will argue on the internet that the market is rigged. This cycle never changes. What actually separates winners is not timing the bottom or the top. It's surviving the middle without self-sabotage. And let's confront the big fantasy that quietly poisons this entire space. The belief that everyone who holds some XRP today will ride it to life-changing wealth. That is statistically impossible. Markets transfer money from the impatient to the disciplined. Always have, always will. The asset doesn't decide who wins. Behavior does. If institutions truly scale into this asset class the way the infrastructure suggests they might, the market will not behave politely. It will not move in smooth stair steps. It will violently reprices upward, then brutally correct, then consolidate while weak hands exit, and then repeat. That's how capital concentrates. And yes, that means drawdowns will come. That means euphoria will come. That means narratives will flip multiple times. And through all of that, the only thing that will matter is whether your position is built on conviction and sizing, not leverage and emotion. Because leverage doesn't compound wealth. Leverage compounds mistakes. If your position size is so large that normal volatility controls your psychology, then your position is already too big. That's not confidence. That's gambling with extra steps. True conviction survives boredom, doubt, delays, and pullbacks without demanding constant validation. And I'll say this clearly because too many creators refuse to. There is absolutely a world where XRP performs incredibly well, and a world where it underperforms expectations. Anyone who claims certainty is selling you entertainment, not analysis. Probability is what we trade, not guarantees. But probability right now is being shaped by regulatory normalization, institutional infrastructure, constrained liquid supply, global payment utility, and long cycle capital rotation. Those are not retail narratives. Those are macro forces, and macro forces don't resolve in weeks. They resolve in years. So if you're here expecting a quick flip, you're in the wrong mindset. But if you're here understanding that wealth is built through structured exposure to long-term asymmetry, then you finally understand what this market actually rewards. Last thing, and I mean this seriously. No video, no chart, no influencer, and no prediction replaces your own responsibility. This market will punish blind faith faster than anything else you've ever touched financially. So take what you learn here as information, not instruction. Build positions that won't force emotional decisions. Respect risk, respect time, and above all, don't confuse hope with strategy. That's how people actually make it. And as always, nothing here is financial advice. Do your own research, understand your own risk, and make your own decisions.